Welcome. Welcome, everyone. It's Angelo Robles, and welcome to At Family Office and the Angelo Robles podcast. Today, Warsh, Iran, gold, AI, Bitcoin, first company to 100 trillion, and everything, the death of everything that you thought was safe. The conversation, honestly, that Wall Street should be having, but they're not. Our special guest today is Ram Ahluwalia, CIO of Lumida. For the fifth time in the last 2 years, Ram, it's a pleasure to say, my friend, welcome back. Ram, I cannot hear you.
It's great to see you again, Angelo. It's a real pleasure. I always enjoy these. You're a first-rate critical and global thinker, always on the right trends and asking the right questions. So thanks again for having me.
You're very kind. And for my audience that's newer, Ram is not only one of my favorite guests, perhaps most of my intellectual long-form 2-hour plus discussions, geopolitics, macroeconomics, investing, AI, Bitcoin. We have a lot to cover. And Ram, without further ado, let's get right to it. I'm going to start with something that seems to die down, then rears up quick. I think broadly, investors and family offices underestimate the impact of what we loosely define as the yen carry trade. So in some ways, it's been a free money machine. Now, for context, the yen carry trade lets investors borrow, let's say at 0% in Japan, convert to dollars, buy often US assets yielding 4 to 5%. It's become a 20 plus trillion dollar monster, propping up everything, I would argue, from US treasuries to tech stocks. I don't know, Ram, what could go wrong here?
So I'm actually not really concerned about the yen carry trade or the rising yen and yen borrow rates. Okay, so the reason why is that it's so heavily discussed that markets and market participants adjust around these risks. What hurts markets are left tail surprises that are not anticipated. The Mack truck coming at you 20 miles an hour from 2 miles away doesn't hurt you. So I actually don't think there's much risk around the yen carry trade. So that's my first non-consensus view for you here.
Okay, you're getting right to it. I'm going to give you a little pushback there.
Sure.
Japan's 0% rates effectively, I think, aren't they subsidizing US asset prices for what, a decade of free money flowing into, let's say, Silicon Valley, treasury auctions, and real estate? Where is this? Just because it may not be a black swan does not mean if it unwinds, it's not going to get messy? Or do you think it simply is short term if it does?
The US dollar's also run up quite a bit relative to the yen, despite the fact the US dollar is down relative to other currencies too. So, that effect is offsetting this. And I think that the usage size and scope of the yen carry trade is overblown relative to this impact. Vanguard's not involved in this. The vast majority of investors are not involved in it. Very specialized investors, including Warren Buffett, are involved in this. But even in the case of Warren Buffett, he's doing permanent capital, non-callable carry trades. Those won't have day-to-day impacts. And the nature of how he set up that financing, it's not going to create much risk because it's non-callable. You can't get a margin call. So it's fun to talk about, but I do think it's a nothing burger.
I mean, Ram, if Japan holds more US debt than any other nation, of course, outside of our own country, meaning with treasuries, and they run the yen carry trade because they trust the US will stabilize the currency. And might they have a little too much trust? Now, we could get into the politics of it. Recent elections in Japan, very aligned broadly with Trump. I guess Japan is a tremendous friend of the US, but they have a lot of treasuries. I guess you're more comfortable swimming in these dangerous waters. It makes me a little nervous.
Yeah, let me share with you. This is a chart of the USD versus JPY, and again, you can see that the US dollar has actually rallied relative to the Japanese yen, since May of last year. So, if you're borrowing in one currency and paying in another, there are a lot of ways to manage that risk too. So, I just don't see much risk around this. I just don't see. I mean, what you highlighted there is more like sovereign risk. If sovereign does something, I think, and you just pointed out there's a lot of alignment there, so it's hard to even see the sovereign policy change. So I don't see much risk. I do see a lot of opportunity in Japan as well as international markets. We have several points of exposure, at least in Japan. We have high single-digit exposure in Japan, so we like that market. We like that in a lot of international markets too. But I think this is much ado about nothing. Remember Kyle Bass in Texas?
Of course.
He's been talking about the unwind of this for like, what, 10, 12, 15 years, waiting for something to go bump in the night and paying premiums to get some convex exposure if something blows up. And then here we are 10, 12, 15 years later.
Well, a broken clock is right twice a day, I guess they say.
Yeah, in August of last year, we had this mini yen carry trade unwind, but markets learn from that too. So risk committees get together, PM sit down with the risk committees, and they say, okay, here's our framework, and they monitor every day. And it's such a slow moving phenomena that it doesn't create risk. It doesn't create real risk here.
Ram, we're going to come back to US debt, the deficit, the dollar versus the world. But there's a subject that I haven't covered that I think you have really deep thoughts on, that I think my audience, investors and family offices would benefit from. I'm loosely going to define our next section, probably 3 or 4 questions, around what I call the sword. And the sword is Iran. So precision weaponry. What do I mean by that? Instead of bombs or boots on the ground, the Treasury collapsed Iran's economy with keystrokes. Isn't this the evolution of statecraft, achieving strategic objection without yet true kinetic warfare or American casualties?
It's sanctions as an instrument of foreign policy, and the U.S. has been doing this quite a bit for decades. Really with the USA Patriot Act, I argue it stepped up, right? The USA Patriot Act played an important role in prying open Swiss banks and ending the privacy safeguards that customers of Swiss banks have. And then you add to that the KYC AML regime. But the Ukraine war, the Russian invasion of Ukraine, also elevated the visibility of sanctions, and you had the BRICS countries attempt to formulate some common currency response to this, which was nonsense, wasn't going anywhere because they're not natural trading partners. Now you see some of this in Iran, but I think in Iran there are other issues too that are coming to the surface. You've got a very young population in Iran relative to most countries, and young people looking for opportunity. What started those protests were when the Iranian government had stimmy checks go out in an area that had very high inflation. In an era of high inflation, stimmy checks go out, and the stimmy checks were nothing, and that started provoking protests and riots. So I think that's like the proximate cause for the issues you have here. This deep-seated resentment by the young against unelected leaders, and they want change.
If I could build upon a little bit of each of our comments relative to that. So I believe it's pronounced real, hyperinflation creates immediate pressure for regime change or negotiation. In some ways, isn't that more humane than decades-long sanctions that often, in the end, achieve very little or nothing?
Yeah, it's self-inflicted. No, you're right. Look, inflation leads to regime change. We've seen that with Weimar hyperinflation. We saw that in the most recent election. Trump won in no small part due to elevated inflation. He ran on a kitchen table, groceries, bread and butter kind of meat and potatoes campaign. The bills are too high, the gas bills are too high, inflation's too high. So yeah, it is interesting to just see how powerful inflation is, and that I do believe is a primary driver of what's destabilizing Iran now.
A little bit back to my first question relative to that. By controlling dollar clearing, the US has structural leverage that probably is impossible to replicate. Now, this goes down to being the world reserve currency. The US, I guess, unless you're a nuclear power country, will do everything in our power, including militarily, to protect that. Yet it still has gone down and down a little bit over the recent decade or so. How important is this, coupled with the social unrest and change and a rising younger generation that you describe? And this becomes a powerful 1-2 punch. How do you think this could end?
Well, I don't think much is going to change, right? There's no good alternative to the US dollar. Oil still settled in US dollars. Our primary trading partners, Canada and Mexico, notwithstanding the recent trade wars and issues, dollar still relevant there. You saw that there was an exemption on tariffs as it relates to Taiwan semiconductor. You're going to see the same thing with Canada and Mexico. Would not be surprised to see a resurrection of the free trade agreements we had. They won't call it free trade, but it'll be very similar. So I don't think there's any alternative. There's no alternative, right? It's not the euro. So I think that the dollar's position is pretty secure. Now the current administration hasn't made it easy for holders and users of the dollar. And their international players and even U.S. players are diversifying away from U.S. dollar-denominated assets. That's true, but it's still the primary settlement currency of the world, and nothing's on the horizon that might change that.
China and Russia, I'm assuming they saw this. I could argue they know that they're vulnerable. But doesn't that also deter aggression? If adversaries know dollar exclusion means economic death, and that could lead to civil unrest in their countries and a changing of those in power, that gives the US, Trump, the dollar a very heavy hand, which I guess you hinted at.
Mm-hmm.
I don't know if I'm almost asking, if you were them, what would you do to counter that? It's a tough counter.
Yeah, no, it's a great question. So those are the two countries, along with Iran and North Korea, that would benefit the most from an alternative to the U.S. dollar, right? So they are, Russia's felt the threat of and pressure of sanctions. China sees that. China says, "Gee, we don't want that to happen to us." They started to buy gold instead of U.S. Treasury bonds. That's not going to stop anytime soon. So they need an alternative. Well, the alternative is not Bitcoin for them either. Bitcoin is now identified with Trump and American policy. Now you have more Bitcoin mining. It's not that. So they don't have many choices either. States like to have control of their currency. So they're not going to adopt some decentralized currency, right? They want to enjoy the benefit of seniorage too. They want to limit capital flight too. They want to control their population. So, the best thing they can do is buy assets like gold, and that's what they've been doing. That explains the bid in these assets. The other is rare earth materials, a kind of pseudo currency. Use that as a bargaining chip. But they don't have a great competitive position. There are very few alternatives. Right? The United States is still the least dirty shirt in the laundry basket.
Well, we're going to dive into that and how this plays off my next series of questions and kind of economic statecraft. I could almost call it the Besant doctrine. So why don't we start with, do Trump, Besant, and the US reward, I'm going to use the word reformers? The 20 billion Argentinian swap rewards Malay's pro-market reforms while crushing Iran's theocracy. Isn't that exactly how a hegemon should behave? heavy-handed or not?
So the policy will be to expand emerging market adoption of US dollar-backed stablecoins. We're going to do more of that. Stablecoins are an incredible instrument to advance US dollarization around the world because most people live in regimes with high inflation rates and they want a stable currency to provide for their families and save. And so the US dollar adoption will go up around the world. So that's one. On Iran, I mean, they have sanctions in place. I'm not sure what's incremental to that per se, right? I don't think they obviously it's a topic of focus, but I think that the sanctions card's been played. Now there are other questions there.
Oh, Ram, you bring up some very interesting things that I have spoken about. Earlier in the summer of 2025, I don't think it got enough messaging and credit. And whether it was Besant, Trump, broadly his administration, I'm going to go with somewhat genius. And pardon the pun, it was called the Genius Act, which relates to what you spoke about as stablecoins. And if the US dollar is somewhat of a Ponzi scheme backed by nothing, this could be a hell of a way to keep that Ponzi scheme going, I could argue, for decades. Did you want to expand a little bit about the Genius Act stablecoins and why it may have been a underratedly brilliant move?
Yeah, well, two things. One, so what the dollar is backed by is the foreign reserves of the United States. The issue with the foreign reserves is that the quality of those reserves have declined over time, starting with the 2008 financial crisis. And second, there's been a willingness to print money. It's called quantitative easing, which again is also a post-2008 financial crisis issue. So there's a backing for the dollar. It's the foreign reserves we have. Now on the Genius Act, it really is it's a great bill. It's an incredible accomplishment, and it will help Americans. It will help individuals in emerging markets that live in an unpredictable inflation regime, and inflation is a tax on the poorest amongst us. It causes a lot of issues, from a funding perspective, if you're Treasury Secretary Scott Bessent, you are the number one salesman of bonds globally, specifically U.S. sovereign debt. So if you have stablecoins taking greater share in emerging markets, then you are broadening the base of eligible buyers in a world where China's purchasing gold, and a lot of large money managers are moving away from buying U.S. sovereign debt. So, it's an incredible policy. It's a very good policy.
Back a little bit to the broader themes that we've been discussing, because I do think we're not hearing enough about this, and family offices, they kind of need to be pounded with it. And we're going to get to in a second what they could do and benefit from it. So the BRICS alternative, like the digital yuan, are 10 plus years away from some sort of maturity. The Genius Act and stablecoins may have been a brilliant counter to that from the US government. If the US weaponizes and it forces adversaries to waste their money, time, and resources building likely inferior systems, I mean, that's kind of strategic. We have them playing defense, taking their mind off offense, while the US, the dollar, maintains compounding advantages. Now, there's nuances around that could run very deep. Yeah. And I know we covered it to some degree already, but what a powerful strategy.
Yeah, there's no BRICS alternatives going to come anytime soon, next 10 years, next 20 years, next 30 years. First off, by the way, Trump has said if there's any attempt to do that, he would inflict sanctions on those. And we haven't really seen much discussion of that. The second thing is you need some trading relationship between these countries, and they're limited to few natural trading opportunities. For example, Brazil can export oil, well, so can Russia. What's the natural trading arrangement between these two? Mm-hmm. So you need to have that. The United States has all sorts of trading relationships we export energy. We also import energy. We export defense equipment to Saudi Arabia. We might import low-cost oil. A lot of trading relationships that makes the U.S. dollar ensconced in these systems. BRICS doesn't have any of that. So
I mean, correct.
They're natural adversaries too. Like China and India are natural adversaries, right? So India and Japan and South Korea and the Philippines don't want to see a rising hegemon in China, right? So it's just difficult to get any alternative off the ground.
I mean, everyone has predicted the dollar decline. I mean, since I was a kid, going back to the 70s. And yeah, I mean, guess relative against gold, sure. But as a form of currency actively used in the world, it's been very dominant. And yes, as I mentioned, weaponization has proven the dollar to somewhat be indispensable. Why don't I change my question or progress my question into, if I'm a significant family office, what does all this mean? Should I be afraid that I have too much in treasuries? Do I have too little? Should I have more in gold? Uh, how does this impact, from the yen carry trade to Iran to everything we're talking about, the impact of, let's go with cash and fixed income in my portfolio?
I don't know why people own sovereign debt, especially U.S. treasuries. There's a few bubbles out there. One is the U.S. sovereign debt bubble. Another is OpenAI stock. Those are two bubbles that are easy to identify. I don't know why people own treasuries unless you're going to close on a mortgage next month, which family offices aren't. It makes no sense. There's a lot of yield you can find in the world, and owning treasuries that are going from a 4% rate down to 3% in an environment where inflation is 2.8% doesn't make any sense. It's obviously a bad decision. I find it amazing that people don't, diversify away from owning U.S. sovereign debt. And look at the picture for rates. There's a lot of pressure for rates to go up, not down. One is you have onshoring and reshoring. That's just inflationary. You're moving manufacturing from a low-cost environment to a high-cost environment, whether it's the U.S. or through an ally, let's say Mexico. Okay. Second, you've got spending that continues, wartime deficits, no end in sight. Sub-bullet on that is Pentagon spending is going up 50% to 1.5 trillion. So, the borrow costs are increasing. The borrowing needs are increasing. There's no addressing the entitlement issues. So it's hard to see a world where rates move lower. Inflation remains stickier and higher. We're at 2.8% inflation, and the Fed is cutting rates. We're not even at the 2% inflation target. The Fed is cutting rates. There's more pressure on the Fed to cut rates. This is why commodities are rallying. Pick a commodity, they're all going up, right? Whether it's a currency-related commodity like gold or silver, which are still up for the year, by the way, notwithstanding the correction 2 weeks ago, and also copper. So, owning sovereign debt and owning U.S. treasuries is got to be a really stupid asset allocation decision. There are many alternatives to owning U.S. debt. Many alternatives to owning U.S. debt.
We are going to hit that one hard a little bit later, Ram. There was an exercise for my members primarily that I did. If I'm a $30 billion, let's broadly go with the word liquid family office, and I'm relatively mediocre in my aggressiveness and really looking at a 100-year plan, what are allocations going to be? And we'll play that with you a little bit later. I'll give a hint. It sounds like I got way more in treasuries and fixed income than you think I should, but we'll give that hook and jump onto that later. So you mentioned kind of physical assets as a monetary rebellion, or at least my words, when central banks are buying tonnage. So the crash of gold after what, 5,589 and 11% correction, like you said, ballpark about 2 weeks ago. Now let's bring gold into the picture relative of our current discussion. And what is your take, and perhaps broadly allocation or reallocation recommendations to families?
it's a difficult read where we stand today on gold. I mean, there's the fundamental bid, which is around initially start with China, and then momentum caught onto it, and now it's carrying on that account. But I would say, where we stand today, and as I mentioned, we picked up both gold and silver shortly after the rout 2 weeks ago. We still have some exposure now, but these are like high momentum assets. So when those trends break, you're supposed to get out. So it's hard to have an asset allocation decision on an asset with that much momentum, right? Gold is up 72% in the last year. So the market is trying to find its direction right now in gold as we speak. Let's see if I can find a chart for you that I can share on the screen here. But right now the market is it's just trying to find its direction on gold. So we'll have to see what happens with it. But you can see here is the parabola. That parabola burst, corrected from 5,000 from this level here, bounced, and now it's just trying to find some direction. So I don't think this is an intellectual exercise around, hey, what's the direction of gold? I think you have to look at the phenomena in the market around gold and other commodities. So I have some exposure here, but I'm prepared to reduce that if that trend breaks.
There was a study that someone shared with me this morning, and broadly my knowledge of working with families, I believe it to be true. The percentage of commodity investments broadly, commodities by family offices, is about 2%. I think shockingly low. But within that, I believe it might have been Goldman Sachs, under 1%, I think it was 0.9, so almost 1% is in gold. If I'm a typical $500 million, $1 billion, $2 billion, $3 billion family office, doesn't that seem too low to you?
Yeah, no, I agree. I think you got to have a couple points of exposure at the least around commodities. I think that makes sense. We're in a commodity super cycle. It's not just gold. It's copper, which has a demand from data centers. It's silver, which finds its application in memory. So it's uranium, and there's a uranium story out there too. So it's all manner of commodities. You shouldn't own commodities all the time. There are certain times where you want to own commodities. In the 70s, commodities did really well. This is not the 70s. We have more productivity growth and more earnings growth, but there are some echoes of the 70s in the current environment, both kind of the geopolitics and the kind of sticky and persistent inflation, although at lower levels than we saw in the 70s. So, I think, there's a role for commodities, and it's performing. It's got strong momentum. I think that makes a lot of sense. Let me double back briefly real quick on the whole bond piece. I think these are related conversations. I mentioned there are alternatives. Let me share this with you. This is the free cash flow yield of Comcast. Comcast is a dinosaur company that is in the cable business. People have been cord cutting, but they own things like NBC Universal and take a look. I mean, it's got 19% free cash flow yield. Okay, that's free cash flow. That's you have a claim on this cash flow by owning the equity of the business. The stock is up 28% year to date. This is one of our stocking stuffer kind of Lumida 2026 stock picks. But that's an example. There's many stocks like that. Why would you want to own bonds in that environment? It's a real earning stream too. It's not a nominal earning stream, meaning it's a real asset. So, you have better inflation protection. And commodities also play a role in inflation protection too. So having some exposure, that's a good idea. Markets move back and forth between fears of slowdown, fears of a recession, and then fears of inflation. We are in a run it hot policy world, and markets are worried about fear of inflation. So that's why energy, oil field services are outperforming tech indices like QQQ, which are over positioned. People own too many of them. Okay. And that's why commodities are doing well also.
And Ram, we may have a little different perspectives. Back to gold, you're going to be more of a pure investor. It's simply easier to do the paper trade. I'm going to be worried about risk, sovereign risk, broadly governmental, what could go wrong. I believe some of the paper risk is a risk in and of itself. I want to have a level of physical ownership. I want to be globally diversified. I want to be in some non-banking institutions, or organizations. My way is more complex. It also involves a level of bearer assets, custody. I don't know if it's something you have a strong opinion about, but if you think a $10 billion family should have 3 or 4% in gold, that's hundreds and hundreds of millions doing that.
Yeah, you raise a great point, right? So paper gold is you own it via the ETF. Physical gold is you've got it and you solved custody around that. At that level of wealth, you should have some physical exposure and custody. And by the way, it's not just gold, but there's decentralized assets also that are portable in time and space that
we are going to get to that one a little later. But yes.
So like there are different kinds of solutions for that. But yeah, I think some of that, but I'm not in the apocalypse camp. I don't think there's any civil war coming. I think our institutions are strong enough to get through that. Things are overall pretty good. The S&P is just touching all-time highs like today. Earnings growth is strong. Inflation is sticky, but it's on the mend. Productivity growth is strong. We're going to get more abundance from AI. People are living longer than ever, including due to technologies like GLP-1s. People also have more PTSD than ever, which has kept a lot of people out of this bull market because they can't separate their politics or their reaction to media from investing. So, but yeah, look, at $10 billion in wealth, you should have gold bars somewhere in a couple places and in a secure way with custody. But you got a lot to think through. That's a hard problem because gold bar doesn't quite help you because it's not divisible enough from a day-to-day transaction level. If you ever enter that left tail scenario, you don't want a gold bar. You actually want like shavings of a gold bar. you want gold coins, right?
Yes, that would be a hell of a lot of gold coins. You'll have a couple of treasure chests there. Is there a scenario, and maybe it's a really bad one, or maybe it's simply the gold markets have been manipulated by governments and powers that be for years, where gold could actually go to $15,000 an ounce?
No, it's not going to happen. That real quick on gold. So supposing we had gold bars, and you had this some issues, blackouts, zombies show up, whatever your disaster scenario is. I couldn't hand someone a gold bar to go buy like groceries and milk, right? The first thing I would do is I'd issue them an IOU. I say, here's a gold bar. You can look at it. I've got it in custody with a third party. Presumably that third party is a bank or some type of custody and security solution. That IOU is actually a form of money. That's what would happen. We start creating money again. We'd start issuing paper certificates, and they would say, well, I don't trust raw money because he's conflicted. Then a third party would step in to play that role of third party fiat, right, backed by gold. Anyway, that's how that world would probably evolve. And that's, again, why you have concepts like decentralized money that's secured by and custodied by encryption. Really novel concept.
And Ram, I'm just going to riff a little bit. And I've known you so we could do this, and hopefully it makes it engaging. You mentioned about 2 or 3 minutes ago, you know what? US is doing some things good. GDP for the last 2 quarters has been great. Inflation's low. Maybe there was some value to renegotiating trade deals and tariffs. But I remember I interviewed you in, might have been late March, and you were a little negative relative to Trump and some of the more global perspectives. Renegotiating trade deals, tariffs were around the corner with Liberation Day. You appeared, and unlike me, I don't think you get caught up in emotions or the political aspects too much. You probably just simply look at the raw numbers. So that was about 9 or so months ago. You appear to have a little different perspective now. Why?
So one is Trump pivoted, which is important. He pivoted, right? So the policy prescription he had with Liberation Day, if implemented, would have been absolutely terrible. And that's why markets puked. And then he pivoted and then he tacoed. And you're seeing it again as recently as this morning when imports connected to Taiwan Semiconductor don't have any tariffs. So that's one. When the policy changes, you should change your mind, right? The second thing, though, is that there has been a significant effect from all of this, which is that the United States public equities market is one of the worst performing in the world. Even if it's up 18% in the last, say, 12 months, it's lagged almost every country out there on all parts of the world, whether it's South Korea or South Africa or South America, South anything, Japan, Canada, Germany, Greece, Italy. Remember the pigs? We used to make fun of the pigs. Pigs are doing great. Pigs are running circles around the US stock market. So there were consequences from that policy mix that have been negative for the performance of US assets. That's true. The macro and markets are related but distinct objects also. The macro is pretty good. It might not feel good, but it is. It is pretty good. We talked about those conditions a bit earlier. It's not good for recent graduates. It's not good for recent graduates where the unemployment rate is unusually high. Combine that with the rise of AI and graduates leaving school with degrees that don't match necessarily the productive job skills and student debt. That area is not doing too well. But overall, this is a stable economy. It's a services economy. Like the number one employer in the vast majority of the United States are healthcare and hospital related, because you've got this aging demographic. The baby boomers are at peak retirement age, and they've got record balance sheets. They have record equity in their homes and in their stocks, and they are spending. They're spending on travel and leisure. They're spending on cruises, spending on restaurants, spending on elective health. So yeah, the economy's fine. From a markets perspective, I think the policies have impacted asset class performance. That's true.
Ram, I'm going to go a little bit back to, and I had my reasons. I wouldn't quite say a diversion for a couple of questions, but now tying in, let's call it the US dollar and gold, but a little different perspective. Judy Shelton is relatively a not overly well known, but I think brilliant in work that she's done as an economist in her books. And she talks about, published, I believe it was 2024, Good as Gold, a framework about how the US dollar can be backed by gold again, not by returning to whatever Bretton Woods in 44, but by using modern financial instruments. Imagine a gold-backed treasury bond issued on America's terms, settled in today's technologies that may relate a little bit to stable coins we mentioned earlier, to some form of central bank digital currency. What perspective would you have? Bad idea or maybe good?
Sovereigns don't want gold-backed money. The tendency and nature of fiat is to enable political powers to spend without controls. That's just the tendency of things. We've seen this throughout history. It's one of the drivers of the demise of the Roman Empire, right? The debasement term comes from the Roman Empire, where they had coins which were backed by a certain amount in ounces, and then over time it was debased, right? So this is the tendency of things. You're not. This is a one-way door. You don't run it back. And after 2008, we had these experiments with quantitative easing. We started purchasing mortgage-backed securities and treasuries, and extraordinary interventions that were ideas in textbooks that most economists never thought we'd actually try. One of those textbooks was written by Ben Bernanke. There was a PhD thesis on it, on the concept of quantitative easing. And as the leader of the Federal Reserve, he actually kind of pulled the glass and pulled the trigger on that. surprisingly, he did it years after the 2008 crisis, like when there was debt monetization with the Maiden Lane portfolio, for example, that the Fed held,
Sure.
and then continued it and brought it back in COVID. So, but yeah, you're not going to see any return to any kind of gold-backed currency. It just doesn't happen. Look at Argentina's default in 2001. Look at what FDR did with the U.S. currency when it was gold-backed. It was I think people don't necessarily know this, but it was deemed illegal to possess gold. There was a forced conversion overnight.
Of course.
It was a theft against the citizens,
100%.
of which the government is representing to protect, right? So, but the nature of things is government issued currency goes down in value over time. That's not going to stop. That's not going to stop.
Governments exist to preserve their power over the people. I don't really think they necessarily represent the people. You mentioned before, I'm going to lump them together, and it may fill out part of our commodity story, silver and copper, both more useful metals than gold, broadly speaking, in industrial use, and especially AI, solar. They took a big hit as well, I guess, made a bit of a comeback. But the macro story, and we'll get more into AI a little later, how could you not be bullish unless you feel it's really manipulated in silver and copper, as well as others, rare earths, etc.?
Yeah, I like both the fundamental themes and stories behind them, especially copper for the reasons you pointed out around data center. But silver also has a good story as well. But these names have a lot of momentum behind them, and when assets have a lot of momentum, they attract momentum investors and momentum traders. So they will start to correlate to anything else with momentum. Okay. So you'll notice, for example, like Bitcoin is down and like software stocks are down. There's a natural correlation between those two. The reason why is because I'm going to make this up now, this profile, but think of it like your prototypical West Coast tech bro. They own SaaS stocks, Tesla, Bitcoin. The portfolio is rising and falling together, right? So, so everyone's talking about gold and silver and copper now, and it is a momentum trade now. They will rise and fall together. They're cross-correlated now. They're very much like the same trade now. So they added really good diversification like 1 or 2 years ago. It's still a decent opportunity now, but it's how you approach it should be very different. Like 2 years ago, for example, we all knew about the copper demand because of the connection to data center. Everyone knew that, and copper had an incredible run. And then it collapsed and it dropped 30%. By the way, that happened just 6 months ago too, right? So timing matters. That you really have to get good timing. Let me show you a chart of copper, for example.
Please.
I'll show you when I got into copper also. And it's not enough to have a good story. Timing matters. This is copper. This is a 3-year chart of copper. This is the 2024. So for those that remember, back in April and May, if you tune into Bloomberg, everyone was talking about copper and data center. It takes 18 years to build a copper mine. Well, guess what? The cure for high prices are high prices. Someone buying here at 30, get back 20%, right? And but if you buy it near a trend line, you're in pretty good shape. So then what happened 6 months ago is this drop here. So we bought it right there, that green dashed line. We said, yeah, let's get some here. But anyway, this was a collapse in copper, got back to the trend line. And all these are very similar to each other. Gold, silver, copper, they're trading similar. And it's not a layup where we are here. It's not a layup. This is a trader's game now. It's a trader's game. It's about technicals at this point.
I'm going to see if I could phrase this into a question. Like you said, the commodities, gold, silver, copper, etc., kind of sold off together. But gold settles physically outside of Swift. Copper moves on what? Ships, not digital rails. When every financial flow, I go back to the word I used earlier, can be weaponized, don't commodities become the only true neutral reserve asset?
I'm processing the question. So commodities are mined, they are abundant. The limitation to access to commodities is mostly regulation, permitting, and not in my backyard considerations, right? Like the United States has access to uranium, but it's difficult to get the permitting and the regulation to get that unlock. So I don't think of it as a reserve asset as, hey, is this a standard that is accepted globally across cultures as a unit of exchange? Gold has achieved that standard across millennia, and it occupies a very special place for because of that. But copper and other commodities have not achieved a moneyness quality to them.
And you hinted at earlier, now I'm going to mention that name, and we're going to do a little bit of a dive into it as it transitions into our well-rounded conversation for investors and family offices very well, and that's going to be Bitcoin. So the crash from about 126 to currently what in the late 60s was, that's the biggest raw dollar in terms of drop off ever in Bitcoin's history. Being invested in Bitcoin for a long time, understanding halving cycles, understanding the frustration of losing 80 or 90%, all things that I've went through. And we're told it's an inflation hedge. We're told that's not going to happen this time. Yet it's still, maybe Schiff is right on some things, it still appears to be very volatile. What is going on and what was behind, from your perspective, that big, let's go with the word drawdown?
Yeah. So a digital currency like Bitcoin is meant to be traded, not hodled. I said this at the Satoshi Roundtable, a very exclusive, high quality conference in Dubai, where I was at 2 weeks ago. My first meeting there was a lunch, and I made this in comment, and it provoked a very visceral and negative reaction. But I believe that's the case, right? It's meant to be traded, not huddled, and you see that now. We thought that it made sense to own Bitcoin in 2023. I wrote about that on Twitter. When we were buying JP Morgan stock, we said, go buy Bitcoin. And then we said Bitcoin is in a bear market, along with other digital assets. Sometime after this IPO debacle, where you had all sorts of garbage being lifted into public markets. And then the break below 100K makes that just an obvious bear market. Okay. So the first lens is, how do we think about this asset? It's a momentum asset, number one. It is a commodity asset. Okay. So those kinds of assets, you want to follow trends. That's what you want to do. It's a trend following asset. That's how I think about it. Okay. The third piece is, well, there are all sorts of narratives and reasons around this or that, or how it's supposed to behave. Those are just stories and ideas we tell ourselves. Like, how does it actually behave? Bitcoin has sold off along with other high beta names, like Palantir, like Robinhood, like small cap growth stocks, like IPOs, like robotics, right? That's what's happened to it. So it's a momentum asset. It's an attention asset also, meaning it does well when there's not much in the way of a competing narrative. So in 2023, you had the March banking crisis. You also had a lot of skepticism around the Federal Reserve and QE and stimulus checks and all this stuff, the hangover of that, elevated inflation. And there wasn't really a competing narrative yet. ChatGPT was still early. NVIDIA still wasn't really on people's radar at that point. So that was a climate when Bitcoin could do really well. Fast forward, Bitcoin and these cryptocurrencies are competing with narratives like AI, quantum stocks. Remember quantum stocks? Those are in a bear market too, along with Bitcoin. And along with other momentum attention, hot money, speculative assets, right? So they rose and they fall together. And that's what's happened here. So that the hot air is left. There are other drivers too, of course, right? There's the 4-year cycle. So the OGs, they started selling around August, September, October of last year, as early as 124K. These OGs, they're sophisticated, they're savvy, they've been through a few cycles. When the insiders start selling, watch out. Every market has a set of insiders. When they start selling, should watch out. They're the most informed parties. So all of that is why Bitcoin went into a bear market. That's how we got to where we are.
Well, let's go a little back and forth on that. You're correct about the OGs because wallets could effectively be tracked. And from my interviews and conversations with them, it did happen. And money moved to other forms of proof of work that are deemed to be maybe not as much part of the system now. Think Zcash and Monero. But we don't want to do an overly deep dive into crypto, but using words that you hinted at earlier, traveling in space and time, and I could have it in my head and I could travel the world in theory with billions of dollars without having the tonnage or the cost of storage and realistic maneuvering with something like quote unquote physical ownership of gold. Now, this goes back to the bigger question. Again, you're more of a hardcore investor. I'm also thinking of hedging risk. What happens when things go wrong? And things do go wrong. Simply look at history. So therefore, I mentioned families have under 1% in gold, let alone only physical. They for sure, most have under 1% broadly in crypto, let alone only Bitcoin. Would you agree? And even if not as much from a tactical investing perspective, from other perspectives, they should have multiple forms of ownership of Bitcoin and crypto that maybe should be 2 or 3%?
So I sold all my crypto. I'm out. That's what I'm doing here. Okay. Now I do have exposure through off-grid Bitcoin mining, which is where you take stranded natural gas that otherwise would be underutilized or flared. And instead, the team we work with, they put on these generators that combust the natural gas. They mine Bitcoin and they sell that. And the cost of Bitcoin production is 35,000. They sell at a prevailing rate. Then I make a 20 or 30, 40% yield on Bitcoin. So I'm doing that. That makes sense because that makes good economic sense. The cost of Bitcoin is primarily in the energy. So if you have low cost, essentially free energy, then that's a good edge. So I like that. You mentioned Zcash, the other one. So I think people have to understand like how crypto works. Like Zcash down 40%, by the way, in the last month. It's a privacy crypto token along with Monero, as I don't know. So what happened is some time ago, Balaji Srinivasan and other quote unquote insiders get together and they say, look, the next year, the story is going to be this token. We need privacy money. And there's a fundamental basis for it. Bitcoin is great for law enforcement because you've got an immutable public ledger, so you can follow transactions, right? So it's great for FinCEN and surveillance and law enforcement for those reasons, right? So they said, gee, like, why don't you get a privacy coin? That's just a story and a meme. And if you're close to these insiders, you have an edge. You can do well. If you're not, then the risk is you fall in love with the story, the meme, and then you're getting dumped on while insiders that conceived of this story are selling out. So that's the risk with this category. Now, in terms of exposure, we talked earlier about how there is really no alternative to the US dollar as a global settlement currency. There is none. Like, where is that alternative? It's not the dollar. It's not the euro. Okay, there is no alternative. Now, what about a non-sovereign, decentralized digital currency? Well, conceptually, that makes sense. Conceptually, that makes a lot of sense. Larry Fink's been talking about that. BlackRock's talking about that, right? Has attributes that are different from gold. It's portable in time and space. But is it a great store of value? No. I mean, you see that. It's in the evidence. It's not. Is there a role for it? Absolutely, sure. Um, your exposure should be timed and managed well. That's the issue with this. Like you really have to know what you're doing, right? These are volatile assets. These are volatile assets, right? Like I was at a holiday party 2 Decembers ago. There was a founder, a well-known founder, CEO of a prominent crypto protocol, and he said, "Congratulations, everyone! We did it. Bitcoin's 100,000." The same holiday party a year later, and he said, "Bitcoin's still 100,000." Meanwhile, the Nasdaq and the SPY had gone up double-digit percentage points, and now fast forward, Bitcoin is 70,000 or so. So the opportunity cost is significant, right? Imagine the S&P goes up 20% year over year, and your assets down 20%, 30%. Opportunity cost is significant. So you need specialized managers that know what they are doing, that are not ideological. You can't be ideological. You're going to see a lot of ideologues get hurt and carried on a structure, and the followers are going to lose money. There are a lot of ideologues out there. They're different tribes. Okay, MicroStrategy has a tribe. Tom Lee has a tribe. Kathy Wood has a tribe. Ray Dalio has a tribe. And a lot of these tribes are monolithic. They have this kind of hardcore vision and this compliance. You must comply with the vision. Mortgage your house. Buy this. I don't think that's going to end well. In fact, I think a lot of those bubbles have been bursting over the last 6 months. Right? Look at ARK. Look at Bitminer. Look at MicroStrategy. The ideologues help create the bubble. They charismatic, visionary leader who's very smart, has a great PowerPoint slides, amazing storyteller, kind of messianic qualities. People like that. It's a human nature. It's human instinct. Get into the tribe. You feel the community. You feel the warmth. All right, he or she's smart. I want to be part of that tribe, right? Just like we like sports teams or the tendency to be nationalistic. And people stop thinking critically and they own way too much. They buy it way too late and they get stuck holding the bag.
And staying on the theme of broadly crypto, it hasn't quite lived up to the promises: digital gold, Bitcoin, digital oil, Ethereum, and Solana. However, going to something that could be the rails for the US government and others, and that would be Ripple, or more specifically, the private company Ripple Labs. How do you broadly think about that? And if you want to weave in a thesis on Ethereum and Solana as well.
I haven't looked at Ripple in a while. My bias would be to short it. That'd be my instinct. I'm not saying you should go do that. Again, I haven't looked at it. I haven't done the underwrite. This is not financial advice, entertainment only. But the top in Ripple was when Fortress and Citadel got together and invested in an absurdly priced round in Ripple. Another top signal was when you had a bunch of VCs invest in Erebor, which is like a crypto bank, at a $2 billion valuation. They don't make any money. These are called top signals. I could go on and on, a lot of top signals. And now you're seeing reality come back. Look at Brex was acquired by Capital One in a take under at a $5 billion valuation. This was like a fintech darling that raised at a 10 or 12 billion in 2021. So they're down 50%, not including inflation, which is another 20%. So there's a bubble in venture capital. Crypto is a type of venture capital. It is liquid venture capital. Okay, because you have tokens that can trade, etc. Yeah, that bubble has burst. The bubble is collapsing. People should focus on the exact opposite of crypto now. They should focus on Comcast. Comcast is up double digit. Free cash flow 20%. It's a Comcast. This is a company. It's an old guard dinosaur company. I'll be the first to call it a dinosaur company. It's outrunning Bitcoin. Right? That's not supposed to happen. Right? Greece is outrunning crypto assets. My main point here is timing matters. Timing matters. I don't want people to lose the message. I have a number of clients, many clients that created the wealth in crypto. And we did a great job acting as a Sherpa to rotate them into other themes and de-risk them at the right time. Things are expensive. Things are expensive and they're cooling off, especially these high beta thematic stories.
This indirectly relates to my questions on Bitcoin and some cryptos and goes back a little bit to our earlier discussion on treasuries and the US dollar. The US for sure weaponizes the dollar. Russians or Serbians lost, what, 300 billion in frozen reserves because basically they were, quote unquote, settled in dollars. When the system can be seized by political decision, does that change the perspective globally ex-US when the dollar is so dominant, when, well, Trump is Trump? And when we're talking about things that are outside of the system, whether it's physical ownership of gold or Bitcoin, doesn't that give a little bit of hedging and diversity of risk that I'm not only tied into the US dollar, something that spigot can be controlled by powers that be, the entity, by executive orders? And again, maybe I think of the worst of what could go wrong too much. I'm just saying a percentage of the assets in the Swiss franc, in a Norwegian krona, in a Singapore dollar, in gold, in silver, in Bitcoin, and certain other crypto. Am I that wrong?
You know, you give a lot of credit to these leaders of these nation states and political actors, and they don't understand this stuff. Remember, there's this comment in Davos. I think someone was talking to Brian Armstrong. He said, "Look, I don't believe in privately issued Bitcoin." And what is he talking about? It's not even issued privately. It's not a security. It's decentralized. It's code. It's on chain. It follows a programmatic process. They don't understand what you're saying, which is, gee, shouldn't you consider alternatives that are non-sovereign? That's what you're sharing. Yeah, they should. They don't understand this stuff. It's so I don't think that's going to happen. I don't think it's going to happen. There are definitely alternatives. I'm not necessarily of the view that I'd be owning, currencies. I think there's a lot of great investing opportunities out there, especially in international markets. What they are doing is investing in their home countries now, because that's working. That's beating the S&P. They're happy to do that. So they don't need to think right now. I'm not sure people fully realize just how strong international markets are versus the US. It's not just a mild level of outperformance. It is strong. It is lapping 2 times or 3 times. Santander, leading bank in Spain, is up 130% in the last 12 months. Spain, the country, just buying the ETF, buying the S&P for Spain is up 80%. And that's not I'm not cherry picking. We talk about many other countries. So they don't need to think because their home markets are working.
Well, let's have a little pushback, Ram. I hear what you're saying. You're using a short window, which doesn't historically necessarily hold up that well. You mentioned Spain. Spain is definitively a socialist country. These are small countries. Small things can move the needle. I look at the big picture, the US versus China. To me, it's really where it's at. That's no disrespect to other countries some of them are doing amazing things in their little bubbles. But under the thumb, I could argue, or could be, of the US and China, and AI, the 2 most dominant countries by far in the future of AI, which is going to be horizontal, going to touch everything. Well, enjoy their little experiments that some countries, like you mentioned, Spain, are doing now. How is this going to hold up to the rigor of AI and job loss and enhancements in 10x production? There's so much going on. Not that I wanted to quite jump in to the AI discussion just yet, but you seem to have nudged me into it.
So it's important not to put these other countries in a box and dismiss them. Well, they're socialists. Like Ram is a capitalist. I'm a capitalist. I believe in free markets, individual liberty, rule of law, and freedom, and human flourishing. That's what I stand for. Those are my values. Okay. Spain has done a number of labor market adjustments, reforms. Spain is growing faster than Germany. It's growing faster than France. It's growing faster than Italy. By the way, Greece is a story too. All those countries have stories. There's a defense investment. Germany has finally exited a 3-year recession, right? So there are multiple good stories out there. Said another way, like these labels, like Spain is social, that's all priced in. That's all priced in. That's backwards, wherever you mirror. Japan, same thing. Japan's got a corporate reform story, right? The JP Morgan of Japan is called MUFG. Guess what? It's up 45% in the last 12 months. It's lapping JP Morgan. I think it's like double the return on JP Morgan in the last 12 months. Japan, great corporate reform story. They're starting to unlock buybacks or encouraging competition. The regulators want to stop these, keiretsu kind of regimes where you've got entities that don't have much transparency, and so all that's constructive. So yeah, no, I think there are a lot of, even China. China's outrunning the S&P, and China is the direct object of Trump's ire. Like the tariffs are coming down in a lot of places except for China, right? Even China's outrunning the S&P 500. So now they're not socialists, they're not capitalists, they are something else. It's a very unique mix of capitalism and autocracy, right? And industrial policy, right? So yeah, I'd be cautious on assigning a label to a country and say, okay, it can't work because of this or that.
Well,
France, I like to make fun of France. France is outrunning the U.S. I'd be the first to make fun of France. I studied French for 7 years, by the way.
A country where I can't email my employees, and I'm embellishing it a little bit after 5 o'clock.
It's 35-hour work week, and
yeah. Now, but Ram, though, when I look at the world on fire, 9 countries having nuclear weapons, the AI race between U.S. and China, the Cold War between U.S. and China, the fact that the U.S. has incredible energy reserves, natural resources, rule of law, capitalism, venture capital, incredible farmland, wickedly good markets. We could debate some of that. The world kind of settles in dollars, and socialistic countries like Spain and many others, the talented people that are creating, and they're creating something that's being taken from them from blocks of 60, 70%. They're going to have a capitalistic urge, which many of them have done. Look at the UK in terms of moving out. Is that the short term? And the reality is incredible entrepreneurs build companies, employ people, pay taxes, and now that's gonna disperse in the coming, 6 months, year or two. I don't see of what you're saying as being long-term. That means I have to be so tactical moving out of certain positions. Is that realistic?
Yeah, these are multi-year swings. It's not tactical at the quarterly level, but tactical at the annual level. Yes, at that level, yes. That is required in the world ahead. The pace of change is only accelerating with AI. The pace of change is increasing just with the policy volatility that we see now, right? We have this AI tool we created at Lumida called Lumida Invest, and we have a feature in there it's called Trump Watch. It just tracks what Trump says, because you have to track what Trump says now, right? Like
it's doing a lot of tracking.
Right, it's doing a lot of tracking. So it's that's just reality, right? I don't make the rules. That's just reality. Reality is adjusting very quickly. So some people are like, yeah, you're right. Like the United States is an incredible investment opportunity set if you look out over decades ahead, sure. But a 20, 30, 40% opportunity cost, most people would find is material, and they would want to act on that. If it's a 5% swing, then okay, maybe we let that one go.
Sure. Maybe 2 follow-up questions that directly and indirectly relate, and maybe more big picture, macro, and directions of society. One, although it feels like old news now, 2 or 2.5 weeks ago, Davos. And it seems like Trump, Bessent, and Lutnick went in there swinging. Mainly on Greenland, but a variety of other factors. What is your take on it from a U.S. or non-U.S. perspective? And really, has it had in the moment any impact? And how should family offices be thinking strategically and tactfully on their investments relative to the actions that came out of that?
thought it was the most productive Davos we probably ever seen, because it no longer was an echo chamber and a bubble of people talking to each other that kind of agree with each other. There was more debate. It wasn't just Trump and Lutnick, but you also had, for example, Germany's Chancellor Merz, who was criticizing the European Union and criticizing Germany for neglecting their investment in nuclear, for example, and talking about the need to deregulate. You also had Elon Musk there. You had the CEO of Coinbase was there. So this is a far more intellectually diverse mix than we had ever seen before. So that's all great, very productive, helpful. Candid conversation. So in terms of family offices and kind of takeaways there, I thought it was very interesting to see Carney's speech. I thought,
Sure.
Clearly he's a very high IQ individual. He would run circles around anyone in the U.S. DNC, as far as I'm convinced. He just operates at a different level.
That's a pretty low benchmark in the U.S. DNC, but I hear you.
But his intellectual caliber is very high.
Just because his intellectual character is high doesn't mean that the actions he takes and his leadership is good.
I agree. So he stole the show on the Monday of Davos, and he came out and he said, "Look, this is not a transition; it is a rupture." It was a very eloquent and beautiful speech. By the way, I'm not agreeing with him. I'm just giving points. In Olympics, difficulty level 10. That's a 9.8. He exceeded expectations, and he voiced a statement that other international leaders struggle to articulate. And he channeled that very crisply. So that was impressive. However, I think he overreached. Like he trying to cut a trade deal with China to import EVs when your primary trading partner is the United States. Canada and the United States will always have significant bilateral trade for decades to come, for geographic reasons and for other reasons. We've established manufacturing and supply chains going back and forth. That's not going to change. And then, Trump just the next day said, "Hey, look, if you do that, then I'm going to bring back tariffs, cut it out." And Carney, according to Besant, stopped it. Then he said, no, he didn't. And I've talked to a few friends in Canada, actually. I have family in Canada too, clients in Canada. One or two really like Carney, but just as many dislike Carney quite a bit. The automotive groups, they didn't like that policy at all of enabling China to sell EVs, in Canada. And leadership is a major question, right? So Quebec had a referendum on whether they wanted to secede from Canada, and it was a 49.5% vote to secede. Alberta, if you do a poll of that population, they want to form their own independent state. So, Canada has its own set of issues. Canada is more fragile than would look like, looking from Carney's speech. So Carney overextended himself. It was a beautiful speech, though. Just way overextended. And, it goes back to realpolitik. This is the era of realpolitik. And hegemons will hegemon. And the U.S., will hegemon, and that's what happened. I don't think I think you can discount a lot of actually what Carney said. I don't think that China deal really goes much anywhere. I think you'll actually see something like the USMCA come back again. I would not be surprised. I won't call it that, but you'll see something like that again. I wouldn't be surprised if Besant called his counterpart in Canada, or Carney himself. I mean, after all, Carney ran their central bank before and said, "Hey, look, work with me on this. Just walk that back. We'll get a deal done together. Just work with me on this." Some conversation like that probably happened back channel. And, I don't think you're going to see much velocity or change come out of what Carney said. I mean, the world is so offsides relative to the policy posture that that Trump admin has. They weren't prepared for that. Not prepared for that. Think about like Greenland and military spending, and it's not prepared. It is a major whipsaw to them, and they can't really adjust quickly enough. So,
Ron,
good.
like to talk about your backyard. You're building a successful company.
Thank
You
you.
have more and more employees than when I spoke to you last year, and kudos to you. You happen to be building it in New York City. I don't know. Mr. Wonderful Kevin O'Leary said, never, never, never do that. You're doing it. Maybe there's a variety of reasons, talent, college resources and talent, etc. But that's kind of the part one, why. And then I'm going to turn my attention, which relates to the topic that we're leaving, and that would be the rise of socialism. Mamdani's the elected mayor. He's a socialist, probably I could argue a communist, but let's see how that plays out. What happens when cost of goods, when taxes go up? Well, the people that pay a lot of the taxes, who are smart people, educated, high earners, often building companies, are going to leave. They're going to move. What is going to happen to New York City, and why are you building there?
So New York City will mostly be fine because there are a lot of controls and constraints that Albany imposes upon New York City. So the degrees of freedom that they have are limited. By the way, the reason why those constraints exist is because, you had mayors in New York back in the 70s that went nuts with spending. And that's why you have this framework now. So there are a lot of limitations. It's unfortunate. We had an opportunity to create 50,000 jobs with Amazon in AOC's borough. That's not happening, but it looks like we'll get 50,000 bathroom stalls on every other corner here. I'd rather do the Amazon jobs. But, I think there'll be a lot more limitations than people think. Is it the rise of socialism, or is it really the rise of populism? I think it's more of the latter. Trump is running left policies. Credit card companies, you can't charge more than 10% interest rate, which makes no sense.
I agree with you.
You cannot. The credit machine is working and it's helping people. We can talk about that if you want. But that's one. Number two, more stimulus checks. Three, ordering Fannie Mae and Freddie Mac to buy mortgage-backed securities. Four, there's talk about maybe enabling homeowners to qualify for mortgage with 1% down. That didn't really work well. Prior to the subprime crisis, when Congress, Fannie and Freddie got behind this. I'm not dismissing the value of folks in housing as an issue, by the way. I'm just trying to make the point here that Trump has a number of left policies, protectionism, put that near the top. The desire to cut rates no matter what. You have a running hot economy. GDP just collected a 5% nominal GDP growth. It's a strong economy. Record earnings growth, double-digit earnings growth, 12% earnings growth. S&P all-time high. Cut rates. That's the message. Elizabeth Warren always wants to cut rates. Every time the FOMC leadership gets in front of Congress, the question is, why aren't we cutting rates more? Never a rate cut Elizabeth Warren didn't like. Trump's saying the same thing. So I think it's really about the rise of populism. It's unfortunate.
Ron,
Fortunate. Yeah.
we have near a $39 trillion deficit, debt, I'm sorry, a $2 trillion deficit. We're raising our military spending. We're passing months ago the big, beautiful bill. We are just adding and adding to the debt. Now, we could listen to Ray Dalio, and that looks really bad. And the logic behind that seems to make sense to me, but I have some disagreements about some end results and conclusions. But I've had a very prominent guest on about a month ago that said, it's not good, but you're overblowing the problem, Angelo, as long as we're the world reserve currency. And look at GDP growth the last 2 quarters, look at the rise of AI, look at the impact that's going to have. We need to kind of do this. Why don't I go somewhere in the middle and allow you to comment on the surface what seems to be very bad, or are we overblowing it?
The best story for the United States is the productivity growth story. Right? We haven't seen productivity growth like we have now since the late 90s, when there was another technical innovation coming online. And of course, that was the internet. That's the best story we have going for the United States. We didn't have that story in the 1970s when you had a whiff of stagflation.
Mm-hmm.
Not had stagflation. So that's the key difference between now and the 70s. You also have lower energy costs too. There's a policy focus on increasing energy production. The U.S. is the world's leading exporter of energy, and that's important too. But yeah, the bailout is going to have to be technology, AI, and productivity. That has to be the bailout. That's how you sail through this narrow channel of risks. So yeah, look, I'm on the optimistic side of things. The important thing is you have to be an owner of real assets. If you're not an owner of stocks, if you don't own a home with a mortgage that's depreciating in value due to inflation,
100%. You're
right. That's the key thing. As long as you're if you own real assets, then those assets will reprice in nominal terms. That's what real assets are. That's the definition of a real asset. If you don't own real assets, then you're screwed. And that economic populism is directed to this population, even though a lot of those policies aren't really helpful for the population. They're inflationary. And inflation, as you know, Milton Friedman said, is one of the most aggressive taxes, especially on the poor.
Of course.
It's true. I mean, it changes regimes, and you look at countries that have high inflation rates in other parts of the world, and it causes a lot of damage. Argentina is finally getting its act together after decades of mismanagement, and the inflation rate's coming down, and economic output's growing due to just a very different approach. But prior to that, the Argentines, and maybe even now, they're essentially like global macro traders. They have to run to Uruguay where they can convert their currency and pull it in a dollar-backed currency. There's significant transaction costs and mental time costs that the population has to do to avoid inflation. They shouldn't have to do that. You shouldn't have to be a global macro trader reading FX rates to look out for your family and live a good life. That is a significant cost of inflation.
And Ram, the audience a little bit of color. We have ballpark. Ram may give us a little longer, but about 30, 35 minutes left. We're going to cover Warsh, and we are going to name some stock names, talk about assets, allocations. So we got some really good content ahead. There were some good questions that came in. Russell, and I think earlier on in our dialogue, Ram already answered. Geopolitical risk accelerates. Do you see gold breaking structurally higher? Here's one question, Ram. Maybe we could give it a little bit of love. If inflation were entirely course corrected, what would a 1-to-1 ratio be for the petrodollar?
If inflation were entirely, if inflation rates came down? So
let's go. Yes.
Yeah, look, oil right now is it's looking at $64, right? It's in the low 60s. So a lot of things have gone up in price except for oil, right? So that's why gas prices have come down, and that's because of deliberate policy, right? So I think oil price would be lower if you had lower inflation, right? But overall, that is deliberate policy, and it's helped the U.S. consumer. It's helped industries that rely on oil and energy, like airlines, for example, or automotive companies. The stock price of those industry groups are doing well too.
And it looks like there might have been some comments as we were talking a couple of minutes ago, like sounds like a hyperinflationary condition. Now, we could talk about money printing and the impact on inflation. Is true inflation truly known? Is it very individualized? I can't go by government numbers, but then I go to AI. AI should be deflationary. What do you think about his words of, I guess, we're money printing a hyperinflationary environment? Is this different?
So the money printing, what it drives higher is asset prices. This is the big learning of the last 5 years. So where did the inflation show up from the 2010s QE and the 2020s? It was asset price inflation. That's why if you own real assets, you're going to do well. Now, we also had price inflation after COVID, but that was because not only did you have money printing through QE, but you also had $3 trillion in back-to-back fiscal stimulus packages and stimulus checks. So that created also asset price inflation. For those that remember 2021, you got that sugar rush and then a bear market afterward, but it also created inflation in goods and services. So, I would expect more of the same, right? If I would expect that it's just you should have a bias to owning assets and fixed rate debt.
And Ram, I'm going to wind it up and give the floor to you on this one. It's supposed to be one of our core subjects, but I know the audience does want us to get to allocations, specific stocks, your opinion. In the 5 interviews we've done, those are always the most popular sessions. And trust me, audience, I'm ready to rock on that. So stay with us. But I do think we have to cover, otherwise I got to change my title as well, the Warsh doctrine, proposed as the new Fed chair. Maybe you could give a little counterbalance between him and Powell and how you think this could play out, interest rates, which we briefly hinted on. And like I said, on this one, I'm going to wind you up a little bit and let you do your thing. Ram, that floor is yours.
So Warsh was the runner-up to Powell, and Trump passed on Warsh. He would have been maybe the youngest FOMC leader. Warsh historically has been a hawk. So it's a surprising pick because, Trump has been saying, I want the Fed to lower rates, and Warsh is a hawk. So there's a mismatch. Like Hassett would have been the right pick for Trump because they are consistent. In my view, Rick Reeder would have been the best, the CIO of BlackRock. If the US government wants to sell bonds, get the biggest bond buyer in the world, which is BlackRock, to be your Fed chair, and that would restore credibility to bond market investors. It would have been a phenomenal pick. So what's going on here with Warsh? So one, there are family relationships between the two. So that's something to consider. I think it's a surprising pick. So what does it mean? It means one of two things. Either Warsh will be hawkish, or Warsh won't be independent. Neither of those are really good, actually, for asset prices, right? So either Warsh has spine and he will stick to his principles, one of which is not engaging in quantitative easing ever again, which I think is a good idea, by the way. Or Warsh has signaled that he'll be flexible and won't be independent. Neither of those are really good. I don't like that. So I thought it was a surprising pick. We'll see what happens. We'll see how things unfold here. Do markets test Warsh? There's this joke they say in kind of the Fed policy picking circles when you have this conversation, this vetting process, when you vet the leader, you interview them a bunch of times, and once they become Fed chair, what they do is very different than what they said they would do. So we'll see what happens with Warsh, but it's a surprising pick from given his stated policy history.
Generally, you mentioned earlier that people need to own assets. You're 100% correct. I know what it's like to be dirt poor. You find a way to be active in the markets. Today's world, Robinhood and all that, it's never been easier. It gets you skin in the game, it gets you excited about it, and makes you a long-term investor. So we're looking at potentially when interest rates go lower, although that could have a negative impact on inflation, it generally is good for the markets and things like crypto. Where do you think, taking the question back to who's in that chair now, Jerome Powell, where do you think he went wrong?
Well, he went wrong during COVID QE. It was a massive mistake. Look, it's easy to be a hindsight 2020 Monday morning quarterback. You had a pandemic. No one understood the gravity, significance of it. You hadn't had one since the Spanish flu. But that might excuse like the initial response, which I thought was good. It's like the corporate bond market was frozen. They injected some liquidity there. That made sense. But back to back packages didn't make any sense. So that's where you went wrong. Number one. Number two was not raising rates soon enough and correcting the mistake. They were slow to correct the mistake. Prior to COVID, I think he was doing a decent job. I also liked how he conducted himself really the last 2 years. He held rates higher for longer, which was the right move. That was the right move. He did that in the face of a lot of political pressure. So I give him credit. I've given credit for kind of the most recent 2 years. I also, and this is my non-consensus view, I think it was a mistake to cut rates the last October, November, December, and then prior to that, I've been consistent around that. So the Fed, they cut rates in December, and then like 2 days afterward, it says GDP comes in at a 5% rate. So that shows you the Fed made a mistake. You don't cut rates when you have a 5% GDP growth rate. You're supposed to be counter-cyclical, not pro-cyclical. And that's why you have commodities taken off. That's why you have energy stocks taken off. That's why it's hard to see a world where the 10-year rate declines, which is going to go against the objective of making Main Street more affordable and making mortgages more affordable.
And Ron, we're going to get to the markets, allocations, stocks, and AI stocks, of course, actually after my next comment and perhaps question to Ram. And I know it's maybe a little bit off topic, but I know that you're smart. I know that you utilize AI. You've built certain systems internally. As someone like myself, who's not only active from the geopolitical and macro perspective of it, active in direct and public markets investing, I've created apps. I've written ebooks about it. And in the last week, some of the developments, audience, you're still not getting it. The advancements in Claude and what they came out with in 4.6, ChatGPT 5.3, and what I'm seeing with the new Mac Mini. Have you looked at this new Mac Mini, how I could run sovereign systems and open source systems and keep it out of the cloud and not bleed IP? And the big ones I was going to get to, and I've been talking about this, AI agents, agent swarms, and take a look at OpenClaw. I basically have to rewrite my near 200-page ebook. And by the way, I started on it yesterday. I'll be done by the weekend. So members, I got you covered. Ram, and I know we're a little bit in my backyard now with this topic, but AI is changing everything. And just the last week has been incredible. I'm putting these to use right now, and I'm overwhelmed by it. It's incredible. Like I could do more with less. And that's the scary part, meaning people, more with less, better and faster. And certain things I could 10 or 20x production. What are you seeing internally with your use in your company? Now you're adding employees, so good for you. But the things that I mentioned, agent swarms, the Mac Mini, OpenClaw, which is a continuous utilization of various agents and having them sync and work together. This is happening even faster than I thought.
Yeah, look, it's a promising opportunity. It's never been a better time to be alive, right? There's still a lot more to do with AI. We're hiring developers and client service people, etc. We've transformed how we invest with AI. It's a tremendous productivity boost. I'll share my screen here. I'll show you some of the specific use cases. But this is on the lumidainvest.com website. But this is like screenshots of the app I mentioned. We have this in the test flight store on Apple and also on Samsung. It's not in the App Store yet, but if you have test flight, you can get it if you join the waitlist here. But the AI, you can type in a stock ticker, it'll generate a bull bear report. And we taught the AI how to think. We're not asking the AI natively what it thinks. We're giving it a framework. We give it a factor model. We give it case studies. We've taught the AI how to read technical analysis. So we built this site several months ago, by the way. See how Bitcoin there was 89,000, 88,000? It was funny. I remember looking at that. I was like, yeah, put that in there. And the AI had a bearish view. We had a bearish view, so we put it in there. That view was right. So the AI is pretty good at trend following. You see it has sell now in Bitcoin. It's a dated page, but the call was right. Anyway, so it breaks down equity markets, digital asset markets. You can track leading investors. It has Druckenmiller's portfolio in there, has Alternative's portfolio, has Bridgewater's portfolio. It'll go through all their portfolios and give its own independent view of their holdings. So it'll generate ideas. It'll tell you thematically what's working or not working. Investing is about stories we all tell each other. These are themes. These are stories about the world. Data center story, aging demographic story, the commodity story. So you can see what themes are working and not working, which ones are oversold, which ones are overbought. Real-time news integrations. You can file as Twitter integrations. When Trump said now's a great time to buy stocks, that was the day you're supposed to buy stocks. That's why we created a Trump Watch feature. You have to track what Trump is saying. That matters. So we have that. You can see that here too. And we're rolling out curations of the best investment podcasts, because who has time? No one has time, right? I just want the signal. So, we have a team that curates, edits, and finds just the juiciest hot takes from the relevant podcast to help create an edge. But yeah, this is how AI is transforming investing. And, what's next on our roadmap is model portfolios driven by AI. But they still have a human element, meaning you might say, I want to own international, I want to own data center, I want to invest in aging demographics, I don't want to own materials or energy. And the AI will be able to construct a portfolio because it's done the fundamental work. It knows how to do portfolio construction, and it can measure the technicals to know whether you're on the right trends or not. So that's the future. That's the future. I think you're going to see the legacy wealth management category be disrupted. So
100%.
I think Robinhood too. Robinhood has risk. Robinhood is not AI native, right? Robinhood is a dopamine engine. You get a dopamine hit when you buy or sell something. You get the confetti pop. That's rewarding the wrong behavior. I would bet that most people on average have lost money on Robinhood or underperformed the indices from using Robinhood. What you want is dopamine linked to insight, to research, to a new idea. And that's the approach we're taking with AI. But yeah, 100%. It's transformational for investing.
And Rosalind, in the comments, at least in X, various comments come in across multiple social media platforms. Actually, this live with Ram is my largest live of the year. But broadly, you are correct. We don't get enough comments. Ram is a great guest. I think we're both pretty fluid on investing and have strong opinions. And we do encourage audience interaction, both in comments and in questions, and want more of them. So please do, for lack of a better word, bring it on. Our only constraint is really going to be time. Ram, let's have some fun in the last 20, 25 minutes. I'm going to start with a video that I went live in. It was on my own. I gave it some thought. And if I was a $30 billion, now we could chuckle at that, a $30 billion plus single family office, mostly liquid. I'm not looking to be one of the 10 richest people in the world. I don't need to 10x in 7 years, but I don't want to be hyper conservative either. So I broke down an allocation. I'm not going to go through each one. And I'm going to allow you the freedom to go from, I mean, Angelo, come on, 30 billion plus. I may comment on maybe 10 billion and 1 billion, and maybe even a lowly $100 million, because it is different depending on goals, expectations, being able to sleep well at night, liquidity needs, risk tolerance, and the level of wealth you do have. And yes, there is a difference between 100 million and 36 billion. But I'm going to start with one that I think you vehemently disagree with, because I think they'll make it a better dialogue. For that family at 30 billion and up, I recommended in their scenario a third, by far my highest allocation, in broadly cash, treasuries, global fixed income, probably getting about 5 to 5.5%. That kicks off $500 million a year of, let's go with the word, income. I have massive amounts of dry powder. Ram, I have so much dry powder, $10 billion that I could basically buy incredible distressed and other opportunities in. So I could pivot very quickly. Why am I wrong being so high at that percentage? Please.
One of the worst performing categories in investing since the 2008 crisis has been distressed investing. My former life, I used to allocate to hedge funds and private equity, so I got to see all the strategy mixes. We haven't had distress. We have a Fed put economy, a stimulus put economy, Band-Aid everything, no one can feel pain economy. Something drops 2%, someone comes out and says something. So that's the we don't have distress. Where's the distress? There's no distress. Okay, that's one. So the wealth creation isn't going to come from buying this dislocated, distressed asset. There's so many private equity companies that you have competitive auctions. And when you win an auction, you're subject to the winner's curse. You paid the highest price. Now it's like, good luck. I hope you make your money on this asset now, right? So don't position for distress, okay? Opportunity cost is what matters here. So the issue with having a third in cash and bonds is inflation. And there are better alternatives. Like if you want income, for example, MLPs, Master Limited Partnership Trusts, there are some of them out there that generate 8, 10, 12, 15% yield. There's opportunities there. That's one bucket. Another, I mentioned, there are plenty of stocks that have free cash flow yields of 10, 12, 15, 18, 20. I just gave you an example of Comcast has a 19%.
I have an ample stock portfolio, Ram, but I don't want to put 70%
No, but I would think
$30 billion plus.
This is what I would say. I would say we should think about a category of stocks as functionally their bonds. That's what I'm saying. We have to stop thinking about them as stocks. Comcast is really a bond. It's got free cash flow 19%. I think the mistake a lot of advisors and wealth managers make is they say, well, 60-40, 6% stock, 40% bond. I don't know. I see a certain class of stocks as bond substitutes, and they're real assets. So they're better than bonds. So why own bonds? Why own sovereign debt? Other kinds of bonds, I might be able to get my head around, like corporate bonds, but US sovereign debt, I don't get that. Also, there are opportunities in private credit. Not all private credit, by the way. You have to be selective. You have to know what you're doing. It's a $5 trillion asset class. There are some good managers out there. But if you can find private credit where you have a senior secured, senior means first lien position, where you're not lending to software, you're not lending to tech, you're lending to boring businesses with durable cash flows and lots of longevity and history, that can do well because the banks aren't doing the lending, and you can make 10 to 12% there. So that's what I would do with that 1/3. I would increase the yield. Lastly, you can if you have a $36 billion portfolio, if there's some distress opportunity, you have ample liquidity, you have securities-based lending, you can borrow against those assets, borrow $1 billion, and go acquire something. If you need
some other allocations that I had 20% broadly into public equities. Now, again, in a $30 billion example, that's $6 billion. I would like to have picked a larger percentage in gold. I picked it at 2%. 2% is 600 million. And again, I want to have some physical ownership, so that complicates it. My total commodities bucket was ballpark about 7%. But in terms of spicing up the conversation, in that example, I had about 10% in professional sports team or teams. Where am I wrong?
I love the cleverness of this professional sports team idea, like the great tax advantages around it. The smart money is starting to sell sports teams. So it's like the OGs in Bitcoin. The OGs in the sports team business trying to rotate. So I would take a cue from that. It's a popular idea. It's an expensive idea. Popular ideas are usually not great ideas because you may be paying too much for it. I would have substantially more equity exposure. People are living longer than ever. Okay, you need real assets. Equities have good earnings and good free cash flow. You have to position within equities. You have to get good names that are linked to secular trends. Find dominant market leaders that are priced correctly, that are gaining market share, incorporating AI. But there's incredible themes and incredible businesses out there. I would dial up that exposure substantially.
My little disagreement, perhaps, with Ram is I think AI is going to be very, very impactful, in some ways, not very positive, to companies that are not going to be able to adapt. I think SaaS companies are going to be toast. I think there's going to be grave challenges moving forward. And some of the reasons I mentioned in the advancements of AI that really in the last week are going to be exponential this year. Some other controversial takes, I guess you could say, I had about 5% in real estate. I had 2% in private homes, which is ridiculous. You got some really big compounds because in my example, at 30 billion, that's 600 million. So I had about 2% in private homes, penthouses, Dubai, etc. 5% real estate funds, 5% private equity. I know it's doing terrible. And 5% in venture capital. I don't know if I'm newly created as 30 billion, if I want to hire teams of internal people, manage them, and only be a direct investor. With the kind of money I'm talking about, I could literally have a one-on-one meeting with Mark Andreessen, with Peter Thiel, with the biggest names in the industry and get real good insight. And although I like to be hands-on in that scenario at that level of wealth, I think you may be better off being tactical as an LP. With me, some concern over counterparty risk, but hey, life isn't perfect.
The single family homes and that multifamily is not a bad, I like that idea. I would express it differently though. I would focus on markets that have population growth, areas in Florida. Miami's expensive, maybe Jacksonville, Florida. I would do Plano, Texas. I would look at Salt Lake City, Utah. So, follow the population trends. I would avoid trophy properties.
Do you like farms and ranch land?
Land is a great idea, actually.
Of course it is.
Leaving aside farm and where the ranch land distinction, but if you get land is actually indexed to AI and productivity growth. Land is actually high beta on the economy. You have to pick it well. I'll give you an example. Like in Jacksonville, so we have some exposure to land around Jacksonville. Jacksonville's got a deep water port, military, back offices for financial services, and it's priced better than, say, Miami, got population growth, but it's also got a major airport there too. And so the land around that, we're starting to see bids from major logistics companies. I won't name them, but think of like the FedExes and the DHLs of the world. They need that land. So land is not a bad idea. There's some carry costs with taxes, but you don't have to invest much in CapEx, but you have to choose it well. You have to have good foresight. You've got to pick your markets well. So for me, it's less about is it farmland or ranch land. I probably would just focus on land in kind of metro areas that I think are poised to do well, like Plano, Texas, like Jacksonville, like Grand Rapids, Michigan, etc. You can find these hubs. There's definitely the southeastern United States or different, growth areas that, land could work. It only makes sense though if you have substantial wealth. I think you're fine in equities too, right? So, and there are ways to get exposure to land through public equities also.
And I had ballpark, I think it was 4%, what I loosely define as infrastructure, meaning if I have that level of wealth, actually at 30 billion, 4%, I don't know, it's actually not enough money to do some of the things I'm thinking of. I may repurpose some of the capital and fixed income and beef that up and maybe double it. And I would be looking at things like strategic ports that could also delve into real estate. I would probably want to own an airstrip. I'd want to control some of the rails and trucking, logistics, arguably drones. Now, again, and I know the audience is probably going like this. I get it. $1 billion family can't do all this. Even a $10 billion family can't. But the level of wealth that we're talking about is very rarefied air. And that's an opportunity to have control of certain choke points and opportunities that maybe only 100 to 150 families in the world have the resources to do this.
I would say liquidity is a virtue because you can change your mind, and the world is transforming at an extremely rapid pace. Think about how many families overinvested in private equity and venture capital. And I've been saying this for a while. Venture capital is a bubble. We talked a little about that earlier. It's Databricks, which is a SaaS company, raised at an ever higher valuation. Meanwhile, SaaS valuations are as low as they've ever been. There's a mismatch because private venture capital isn't subject to the discipline of mark to market in public markets. So if you're trying to own this infrastructure, you're probably going to own it either through private equity or direct. Direct is a pain. Direct is oversight, management, cost. You have to be the best in the world to operate to do it. Do you have a competitive advantage in that? It's just a headache. It's a headache. If you've got that much wealth, you're not going to spend your time dealing with these headaches, and you're not going to be able to hire an operator better than the operator Blackstone has to go manage these assets. Right? Blackstone's building out data centers. They have the edge on that. They can source it well. They can line up the energy, the utilities. They got the know-how. They know exactly what they're doing. They got a playbook. You have the management headache with direct. So you're going to do private equity. But how's private equity done in the last 10, 15 years? The endowments are trying to shed the private equity at discounts to NAV because private equity is also expensive and overpriced. Again, the winner's curse, competitive auctions. So public equities aren't bad. You got to pick your spots. You got to position well, but they're pretty good. They're pretty good. You get liquidity. You can change your mind. So I would prefer, more of that. I like, what Charlie Munger did. He had a bunch in multifamily real estate. That's not a bad idea. He had Berkshire Hathaway, Costco. Costco's overpriced now, forget that. But he also had a lot of multifamily real estate. I think that could make sense too. That general idea is a good idea.
And I know the audience is going to want us to ram through, pardon the pun, probably 10 different stocks. I promise we're going to end with that. One comment question leading into it, we hinted at it in my preamble, later this week. And I admit I'm not the first one. Cappy Wood, Peter Diamandis at Moonshots did it this week as well, or in the last 7 days. Like what could be the first $100 trillion company? And I don't mean in 20 or 30 years. I mean in 5. So you have to look at a couple of things. One, it's going to absolutely take a market frenzy. But if that converts or becomes hyperinflation, then it really doesn't matter. What is the Dow Jones going to be, $1 million? What is the US dollar not going to be? Like a loaf of bread is going to be like $5,000. So in that example, that's a real bad one to say the company's worth $100 trillion, AKA really marked in dollars in US. So I'm thinking more of a market frenzy. Now, I'm actually going to name some private companies that we may get to when we go a little bit back and forth. But basically, it's going to be under the auspice right now of Elon. It's going to be the merger of SpaceX into XAI, of Twitter, of Neuralink, of Boring, and obviously Tesla, what Tesla's doing in robotics, how that will look in 20 years. But I admit, I'm thinking it closer to a 5-year cycle here. Collectively, we're talking 3 to 5 trillion. So that could be what, 20 to 30x over ballpark 5 years in a market frenzy. So are we having fun here? Sure. Please, my audience, do your own diligence, do your own research. We're trying to push the boundaries and have an intriguing discussion. So, Ram, tell me where I'm crazy. And obviously, it comes down to timeline.
So, XAI and Tesla, first of all, Elon's an incredible engineer, and his contribution with driverless cars and expanding human reach and getting a culture of innovation and attempts to cut costs from the federal government, they're impressive, right? So give credit for that. He's an incredible engineer, incredible innovator, incredible visionary, okay? So these deals with XAI and Tesla, this is called self-dealing. There's no mark to market. It's just funny math. It's funny numbers. He's on both sides of the transaction. You can pick his price. The question is, are Tesla shareholders paying too much? Or SpaceX shareholders paying too much? And what would the mark-to-market price of SpaceX be in the public markets? I can tell you it'll be a lot less than $800 billion, what they're quoting right now. I got offered a chance to buy SpaceX at a 25% discount to the quoted sticker price in the secondary market. What does that tell you? It tells you the quoted sticker price isn't the real price. The real price is the price I got offered. So you're seeing, how many IPOs have we seen go public that have traded substantially down below their IPO offer price?
A lot, and then popped up a lot after that.
Many are still way below their IPO price. The exception would be like CoreWeave, which we invested in. Knock on wood, that's done great. But many haven't, though. Many haven't. Remember Figma? Figma, was offered by Robinhood. Robinhood one IPO. This tells you how broken Robinhood is. They're not designed for investors. It's designed for hype. Offer $100 price. Now it's like 20 something bucks, down 80%. Okay, that was a poster child IPO. So SpaceX will not be digested well by public markets, and neither will OpenAI if they go public at anywhere near the valuations we're talking about. You're talking $1.6 trillion going to be floated on the IPO markets. The U.S. equity market is about $60 trillion in size. Can't handle that, and they're overpriced. They would correct substantially. So I don't think that's the move. I don't think that's the move. The move would be more of leaning to value, leaning to earnings, leaning to free cash flow, leaning to international. It's almost doing the exact opposite of the last 2 years. Investing AI beneficiaries instead of AI CapEx spenders. Look at how QQQ is lagging the Dow Jones Industrials. Dow Jones Industrial hitting all-time highs today. QQQ is lagging. It's lagging the world. So I would tilt towards those ideas. I think I would own a lot of international stocks for the next year, and then we reassess at year end.
I love these discussions. They push the boundaries. They're meant to be somewhat engaging and fun for the audience. Yes, admittingly, I'm talking about a market frenzy for that to happen, where me and Ram have some fundamental differences. I have great respect for his take. I think generally Wall Street, no matter what Munger and Buffett said, he's like he's it to them. Musk has never been a favorite, including of a lot of people. He's the best capital allocator, an incredible entrepreneur. And Wall Street broadly has been wrong about Tesla for the most part, year after year after year after year. And I think we're heading into a world where everything is changing. Now, admittingly, the substrate of energy and component build out and traditional companies, commodities are probably going to have a hell of a run. I agree with that. But I look at a little bit more of the long-term picture and see what he's putting together broadly under likely one big umbrella of X. We'll see how the next year or so plays out to get that in the right direction. We may have to do another podcast in 5 years, Ram, and see who was right on that one.
We'll see. We had a few fun facts about Tesla. So Tesla,
sure,
their trailing PE is 393, and their forward PE is 200. It's insane. This is insane. This is numbers that don't make any sense. Tesla is cutting the Model X and the Model X. I think they make amazing products. I think FSD is real. I have an incredible amount of respect for what Elon has built. Price is what you pay, value is what you get. Tesla's done about the return of the S&P over the last 12 months, except with a lot more volatility. They're focused on humanoids. Humanoids will be transformational, but they're not here. You're betting on product market fit. We don't have that yet. They're going up against Figure, which is competing with them on that front.
Who's a wonderful company. Mm-hmm.
Yep.
And a lot of Chinese companies that are very good in that.
Right. And NVIDIA wants to get involved in all of these businesses that Tesla's involved in. And it's much cheaper, right? So NVIDIA is enabling humanoids from a picks and shovels layer. So they're gonna be the arms dealer to this category. They're getting involved with driverless cars, again, powering the OEMs. I think if you look at the themes that are working and the styles and the factors that are working, Tesla isn't linked to those. So I'd be called. Look at Palantir. Look at Palantir's building incredible software, right? Incredible software, first-rate, talented CEO, CTO, leadership team. U.S. government's a customer. They're down 29% in the last 3 months. Look at the Nifty 50 stocks. The Nifty 50 stocks. These were
from the past.
These were so-called one-decision stocks, the best businesses in the United States and in the world. You just look at them and you admire them. Like Polaroid was one of them, down 90% within 5 to 8 years. I think the only one that's kind of survived that's like Merck. Merck is still doing well, but it's business model quality isn't enough. And even on Buffett, I was critical on Buffett and Munger too. I wrote in February of last year, I said there's a bubble in quality stocks, and you've been seeing that bubble deflate with like FICO has sold off quite a bit. For example, these high, Costco is a bubble. It doesn't make sense. 45 PE ratio doesn't make sense. It's too pricey. Walmart is too pricey now. 45 times earnings doesn't make any sense. So, there's a bubble there too.
Now, Ram, I'm going to buzz through, and you could give one sentence or longer, some private companies that I think are perhaps intriguing. One of them, have you done any research or have any thoughts on Sagaldry, if I pronounced it correctly?
I don't know it.
Okay. How about General Matter?
No, I haven't focused. We've been focused on defense tech more, but go ahead. Yeah.
Okay. And that was the latter one, by the way, an AI nuclear play. On the public markets, relative to, well, maybe I would call it a nuclear back door, have you looked at Centrus Energy?
Yeah, no, I know that. I know that name. I think the ticker is LEU, right? If memory serves.
Yes, you got it.
Yeah, LEU. I've owned this one off and on. Right now it's in the off bucket. Yes, I do know that name though. It's an interesting name. HALEU, provider of high assay, low enriched uranium. It's a thematic stock. Beta isn't working. High beta names aren't working. I put this in the bucket of old guard high beta. 50-day moving average is negative now. The peak is behind it. I think there are better opportunities out there.
Some other ones would be Hadrian Automation, Helion Energy, and one that you have mentioned a couple of times, Figure AI.
Figure AI, you're paying too high a price for not enough revenue. Figure in the private markets, Figure AI, or
yes, correct.
I mean, I don't know what the latest valuation is, but whatever. There's a bubble in venture capital. There's a bubble in private markets. If you have the ability to go sell your venture capital at private stock, you should go sell. When they go public, you're going to get a drawdown.
And back a little bit to what we discussed earlier on crypto, a little bit into Ethereum and Solana. We did a little bit on Ripple Labs, a company that I'm probably more intrigued in than you are. But there's one that I hear no one talk about. Have you looked into Canton?
Yes, I have. Yeah.
What do you think?
So there's business, then there's the asset. Okay. So the asset's in a bear market like all other digital assets. So let's not spend too much time on the asset. Okay. The business makes sense. It's Wall Street, banks, dealers getting together to create their own blockchain to make their workflows more efficient, and doing so in a permissioned way And it's clever and it'll be successful because when the Wall Street banks get together to make something successful, it works, like IHS or Market Partners or ICE. These are all incubations of these Wall Street banks in a consortium. But the asset I'm not a big fan of just because the entire theme is in a bear market. So just avoid it.
And what do you think? And again, I'm somewhat respecting of your time and wanted to buzz through a little bit. How about Anduril?
So I was chasing Anduril for years.
I understand.
I was chasing Anduril for years. I finally got access to it, and it's too expensive now. So I'm investing in the next Anduril. I can't name it here, but I'm investing in like a drone company. We are Lumida investing in a drone company. They have contracts or pipeline with like Taiwan and like the United States Navy. I like defense tech a lot. You got to get the price right. Like the leading U.S. NOCs, U.S. defense contractors, right? Like Northrop Grumman, Lockheed Martin, Boeing. These get to valuations of $230 billion. So Anduril is like $60 to $100 billion, depending on where you access it from. I think it would do really well in an IPO. I think the story is amazing. It's got a big retail following. It have a big pop. But it's getting more speculative. I'd rather own, like when our first round in CoreWeave, we got in at a valuation of $7 billion. That gives me room to grow. I'd rather get in earlier, 2 years before the IPO. The company has a backlog. They can execute against the backlog. And that 2 years gives me a margin of safety. So when they go public, inevitably you'll have a post-lockup expiration where the price can drop somewhat. But I've got a nice margin of safety based on my entry price. And I'd like a lower valuation. Lower valuation also means not just you're buying well, but there's more M&A take-up potential. Like Anduril might be able to acquire my company, for example, the one we're looking at or investing in. So I prefer that kind of idea.
And looking a little bit at plays again around nuclear and quantum and space.
Don't touch quantum. Don't touch quantum.
Yeah, like I like all the cutting edge shit.
So Angelo, no high beta. High beta is done. With the common theme I'm hearing is high beta, hot thematics. That's in a bear market. So S&P all-time highs, Dow Jones all-time as we speak. I think Dow Jones. Let's look at the markets today. Let's take a look at the markets. So markets just went red. Dow hit an all-time high. Dow hit an all-time high. Nasdaq's the worst performer, and Bitcoin's down 2%. That's the theme. What we just saw in this episode of today's market action is a N=1 sample, the larger theme of high beta thematics in a bear market. Robinhood, bear market. Palantir, bear market. Uranium, Centrus Energy, bear market. This is the time to do opposite. We have to do opposite game.
Okay. We have, again, some different perspectives on that. I was going to mention some private and public space plays and things in quantum that I know, of course, are high risk, high reward.
Some of the space is interesting. I acknowledge, by the way, I acknowledge some of those, but you have to be really on the ball and in drones. If you want to do high beta, space and drones, and yes, maybe even some uranium, but I mean, this is a trader move. It's not an investor move. That's how I would approach it. So it's, yeah.
We hinted at it earlier, Ram. And again, you can't cover everything, but there's some interesting companies in the Chinese market. Any that you've looked at for yourself as an allocator?
I bought Tencent like yesterday.
I was going to mention that.
I think I might be a little early. It's possible. I'm a little early. Oh, well, it went up. Did it go up today? Let's take a look. Might be a little early. So maybe wait a bit, don't put your full position on the first step. But I think China has some value in the international scene. But look, I mean, these international markets are doing exceptionally well. South Korea is up 130% in a year, 33% in the last 3 months, right? Greece is up 87% in a year, 20% in the last 3 months. Brazil is up 57% in a year, 20% in the last 3 months. Mexico is up 65% in a year, 21% in the last 3 months. In the last 3 months, they outran the S&P. So we don't need to stretch into creative thematics and disruption to make money. We don't need to stretch, which is great. That's great. We can keep it simple, international. You got momentum, you've got earnings growth, you've got yield, you have good policy that's developing. Keep it simple.
There's some audience questions that came in, Ram. One, you did mention it earlier, and that would be from a maybe more conservative family office perspective around allocations to private credit.
Yeah, there's moves to make in private credit. You got to be careful though, because there's a lot of nonsense in private credit. Also, it's a $5 trillion asset class, and you don't want private credit where they lend to software companies. You don't want private credit where they're lending to technology in general. And when you do private credit, you want to make sure that all the loans are first lien and they're secured. And what is the nature of that security? Can they liquidate whatever that security is or that collateral? You have to know what you're doing in private credit. Is it covenant light? Is it covenant heavy? I mean, private credit it's a deep world. We're talking $5 trillion. So, yeah, I think there are opportunities in private. There's plenty to do in private credit. The banks aren't lending. They pull back after the financial crisis. You can make money in private credit. Yes, there are opportunities in private credit. I think you should take advantage of those. 10 to 12% return, not bad, especially if you're tax exempt. If you're tax exempt, you should own private credit because your average annual return on private credit is greater than the average annual return on the S&P where we stand today. But capital gains make owning the S&P very attractive. Capital gains tax rates are lower than ordinary income taxes.
Two other public companies I have small allocations in, and they relate to data centers, tech, and build out, but not from the traditional perspective. They're old companies, one of them being Corning, the other being Caterpillar.
Yeah, no, so I know them both well. These are both part of industrials, which have had an incredible run. Let me show you the valuation for the industrials category. This is great because, Angelo, these are the chats we have with our CIO team all the time. Let me show you the industrials PE ratio is now 26. It's approaching 2021 levels. Let me show you Caterpillar. Caterpillar is never been more expensive ever. Literally today, it just touched peak valuations, and it's never been more expensive on any metric ever. So no, I don't think this is a good buy. I think this is in below off top mode. It would be really funny if Caterpillar topped today, and it's quite possible, actually. It's quite possible. You might have like nailed it. You might have rung the bell.
What could I say, Ram? I have that impact. Why don't I give you a chance you've hinted at one multiple times, a stock that you really think was good. You mentioned it. What are maybe one or two others that you're willing to share with our audience that you think over at least this year has potential above whatever index it's benchmarked to?
There are a lot of good opportunities there internationally. So I own about 50 stocks, by the way. It's not that you have to find the one stock and load up on it. Do a lot of research. You can find a lot of names that have good properties and good traits. I love all my children. There's not one that I'm like, oh, this is the one. They all have good stories. Otherwise, I wouldn't want to own them. Why would I want to own something that I'm not excited about?
Mm-hmm.
So, I would say let's look internationally. I'm just checking a few markets now. Markets seem to be kind of soft right now, but South Korea does have a good story. It's got leaders like SK Hynix. If you want a cheaper version of Micron, go buy SK Hynix. There's no ADR for it. So you have to buy the country, South Korea, EWI, which also has Samsung, which is linked to the memory play. South Korea is an interesting idea. I think Mexico is an interesting idea as well from a friendshoring perspective. They're beneficiary of these trade wars. May not seem like it now, but Trump and the Prime Minister of Mexico have a good relationship, and Mexico has to be a part of the U.S. manufacturing story. It has to be. So, Americans don't want to work in manufacturing. Brazil, PagSeguro, I think is really interesting. Ticker's PAGS. It's like a fintech bank. It's a cheaper version of Nubank. We own Nubank too. Nubank is pricier. PagSeguro is up 57% in a year, 20% in the last month. It's outrun Nubank, which more people know. Nubank is up 25% in a year, 9% in a month. So, if you get more value, you can get more upside, especially in this environment. Like value is outperforming growth. And in Korea, jumping back there, I like KB Bank. It looks overbought right now. KB Bank is just a bank. Around the world, banks are very attractive. They're doing well. Banks in Germany, the UK, banks in Korea, banks in Mexico. So that category is a good category to consider. Santander, I like a lot. That's one of my
You did mention that.
That's my largest bank position. But HSBC, UBS, Barclays, Deutsche Bank, time your entries well. The time to buy them is not now where we stand. Time them well. Wait a week, maybe 2 weeks, reassess. But those are, there's a lot to do there. Maybe South Korea, the ETF is EWZ, right? Instead of buying gold, you can buy, essentially, if you own the South African index, you own a basket of gold mine. You own all sorts of mine. You got a nice diversified basket, and the country overall is doing pretty well. Again, 58% return in the last year, 22% in the last 3 months. So my main message is focus on international. Japan has a great story. It's run up with the recent election, ran up 6%. So timing matters. Timing matters. But yeah, there are opportunities out there.
It was probably a little bit more of a comment. If Angelo's correct and AI is going to have intelligence that is hard to measure, let's broadly call it, in my words, into, well, if it's collective in 5 or 7 years, it may be immeasurable. How are we going to compete, Ram, as humans? You're a smart guy. You hire smart people. But I could be anyone, anywhere in the world and have resources that are incredible. And what I'm talking about, I would say it's not quite there yet, but we are really close. Is that 18 months? Is that 3 years? And that could change even the future of capitalism. We're talking about energy cost for solving for fusion energy, the advancement of robotics, bringing labor costs to zero. Now, the audience may think this is closer to 15 or 20 years out. I don't. I think it will be impactful. It will be massive initial social unrest. Things could get ugly before they get better. I don't mean to bring you down into my world of sovereign risk and what could go wrong, Ram, but exactly that. You're hiring young, talented people. What happens when you have an agent, AI, that works 168 hours a week and has an unfathomable IQ?
The history of technology has been one of fear. Gutenberg and the printing press, it was not widely accepted because the powers that be wanted to control the books, control information. But overall, technology has benefited humanity, and that's undeniable. And it's going to happen again here too. And it's going to raise productivity growth. It's going to raise living standards. There'll be local costs in local areas like coders in San Francisco. Those coders will quit and start startups and raise money at obscene valuations, which you shouldn't invest in, but then make our lives better. So even though venture capital is a bubble, they're making our lives better. It's like public goods, basic science research in a kind of applied way. So, don't be a Luddite. We're beneficiaries of technology. The world is getting better. There are people that are finding diagnoses for rare medical conditions that scores of doctors have missed for years. More and more of these studies are coming up. We're going to see more of that. People are, we have a shortage of care for the elderly, care for the young. Humanoids can't come fast enough. That won't be addressed in the next 5 years, but we need that. So I wouldn't worry about AI and massive job displacement. There will be new jobs created. It's hard sometimes to identify exactly what those jobs are, but the market is doing that. That earnings that's going to come from that productivity growth is going to be spent somewhere. It's either spent on an investment or it's a consumer spend. Wherever that goes, there's going to be job creation in that category. This is the miracle of markets, the magic of markets. So the invisible hand is a real thing, right? It's easy to identify vocal, local costs, but miss the larger diffuse benefits, which are far greater than those local, vocal, isolated costs.
And Ram, pardon me, please continue.
No, like pharmaceuticals, they're going to get better, in terms of research, in terms of independent verification of the studies of the pharmaceutical. What about call centers? Who you want to talk to a human person better than the AI, better than the like the Amtrak bots that they have, or Bank of America's legacy AI. I'd rather talk to an AI than a human, though. That's coming. Like that's So I think there's a lot of opportunity around AI. It'll be a slow takeoff world. It is a slow takeoff world. It's been a couple of years. We still don't have movies made by AI. We still don't have on-demand entertainment that's personalized to the individual. We still have hallucinations. We don't have AI acting like SaaS yet. So we still have a ways to go on transformation. The most important thing now is the ability to learn, the ability to be flexible. Everyone is an entrepreneur. Everyone is a founder, whether you recognize it or not. What do entrepreneurs do is they're constantly learning, they're adapting, pivoting, listening to the customer. I think if you have kids, you should teach your kids how to be an entrepreneur. That's the most valuable skill set in the age of AI, because AI is going to accelerate change. You got to be dynamic. You have to be resilient. You have to have grit. You got to spot opportunities. You have to get after it. And it's an incredible time to be an entrepreneur also, because AI will accelerate your ability to learn and grow. So you have no choice but to be an entrepreneur, and you'll be better at it with AI.
You kind of answered. I was going to give you a chance to have a final word before I give a close. But since you answered maybe part of it, I'll reposition it a little bit. Closing comments of perhaps what we didn't discuss, but was important. And I know the family offices, we're still early in 2026, and we covered a lot. The yen carry trade, Warsh, gold, AI, silver, commodities, Angelo's $30 billion family, $100 trillion companies. What's maybe something that family offices could walk away from that they should need to learn more about and form their own thesis? So again, what perhaps didn't we cover that's important? And early in the year, looking towards the end of the year, what should families keep an eye for, either a risk or perhaps an opportunity?
I would say, back on investment opportunities and themes, like one bucket would be insurance. Insurance is an AI-proof category. That's good. It's got a moat from regulation. And, I talk about free cash flow yield and earnings growth and valuation. It's got all of that. It's working well today while markets are soft. It's a nice hedge. So the old hedge used to be buy the 10-year bond, have a 60-40 portfolio, because when stocks drop, bonds rally. It doesn't happen anymore. But when stocks drop, insurance companies rally. That's happening. And they have positive expected value, meaning it's not a hedge that has a carry cost per se. You expect it to make money on the hedge. That's a great hedge. That's a cheap hedge. It's a hedge that pays for itself, right? We like those. I don't see anyone talking about insurance. That's a great non-consensus idea. So, like there's a lot to do. There's a lot to do in the insurance space. So I like that from an opportunity perspective. I think the other opportunity, again, I don't hear people talk about this, but it's so obvious. It's follow the baby boomers. What are the baby boomers spending on and what do they need? Travel and leisure, cruises, for example. They're spending money on restaurants, healthcare, nursing homes. If you can invest in nursing homes that are private, let me know. I'm on the hunt. You know what let me show you the PE ratio for a well tower. I would not buy in public markets. Public markets are too expensive. The move to make is buying nursing homes, senior living care facilities in private markets and just take them public. This is well tower. This is far more expensive than NVIDIA. It's like 3 times the valuation multiple of NVIDIA, right?
Mm-hmm.
It's got 137 PE, 70 times forward PE. It's a roll-up of rental housing for seniors. They've got 2,000 communities. And this is the definition of a quality compounder. Look at this. It's a great, that is a wonderful category. That's AI proof too. And you got a wonderful trend at your back. Why would you invest in venture capital or invest in senior living care? That's an obvious trend. And you can get after it. It's doable. You know, if you're in the audience and you're young, motivated, hungry, you have drive, you have work ethic, go build a senior living care facility, prove it out, make money, get one done, get the blueprint done, get a great team, get someone from West Point as an operator next to you, get doers, show the unit economics, and then come to me and raise money. I will write you a check. I would love to be part of that. Then we go roll up. We do a Brad Jacobs roll up maybe. Those are the opportunities.
Man, I think you might have motivated every young entrepreneur in the audience. You're going to get hit up now as I want you to share your contact info so families can learn more. How can they learn more about yourself and Lumida, follow the firm, and reach out to your team to potentially?
Look, if you are if you've established a bona fide offering, you're making money, you've de-risked product market fit, I'd love to get involved. This is a high conviction thesis for me. It's a 10 to 20 year secular trend. That's where people should focus. And you're not going to pay 100 times PE ratio. Amazing. That's how investors should be looking at investing. Auto body shop roll-ups. I'm looking at those 3 times price to free cash flow. How am I going to lose money on this thing? I'm not have AI disruption. One brief story, then Angelo, I'll get back to you. I grew up in a small town upstate New York called Little Falls, New York. It's the land of the lost. It's funded by Social Security, Medicare, Medicaid. People are 70 to 80 plus years old there. Young kids, they leave to the cities. It's slowly hollowing out. Okay, there's like a Stewart's there, gas stations, used car dealerships, funeral homes, and auto body shops. Those are the businesses, and healthcare. Okay, those are the kinds of businesses you want to own in the era of aging demographics. It's the opposite of the high beta world that people have been conditioned in the last 3 years, and the S&P has gone up 70%. Okay, now's the time to do the flip and the turn and rotate. Be mentally flexible. That's the main message I would share, right? It's hard to do that for people, right? How to follow us? We're active on Twitter. That's at Ram Ahluwalia. I have a newsletter I write every Sunday, drops 11 a.m. Eastern time. There you go. And that newsletter, we talk about the big trends in AI, investing ideas and themes. We're also on TikTok and Instagram. We're experimenting different formats there. And then I have a podcast called Lumida Non-Consensus Investing. It's on Spotify or YouTube. So go to YouTube, type in Lumida, hit follow. Same thing for TikTok, Instagram, and Twitter. And my bio on Twitter, there's a link tree. You can find more there. But we do publish different content in different areas. So, the more you follow, the better.
Excellent, Ram. What can I say? You're always very generous with your time, with your thoughts. You share information that you probably don't need to, that is of value and benefit to my audience. I greatly appreciate it. And your audience, which joined us as well. Certainly appreciate you. For those that are less familiar with me, I'm Angelo Robles, the original founder at Family Office Association, which I ran for many a year. I had a chance to have an exit, kind of retired. Probably some of you wish I still did. I kept my social medias active, and with great people like Ram and Adam Robinson and others, started to do a lot of longer form interviews that were deeper than what many of you were used to in the world of investing, macro, even geopolitical and family offices. I do more solos in the last year than I've done before. I have one coming up on the $100 trillion company, and others that I think many of you would find of value. You could go to my @FamilyOffice on YouTube. I'm active on LinkedIn and most socials. I hope to be more active on X. We'll see how that plays out. And I also am the founder of SFO Continuity, a more intimate version of what I did at Family Office Association, a strategy and intelligence community effectively for primarily single family offices. My proprietary content, intellect, sharing resources, and hosting intimate programs around the world. And I do mean around the world. And my marquee program, Around the Corner, coming up every March, this year beginning on March 16th for my members in Palm Beach. If you enjoy conversations that stretch the boundaries of most family office conversations, I don't look to be politically correct. I could say I have strong opinions, but weakly held, and talk about geopolitics, macroeconomics, investing, and certainly within the confines of why it matters for a family office. Also, of course, family office structuring, tax mitigation. I mentioned AI. I think in the world of what I do, I'm by far the most hands-on person using AI. Now, today was an interesting conversation. I could, some would say, be a little combative sometimes, hopefully in a nice way. I greatly enjoyed my conversation with Ram. There's certain things we have some fundamental differences over, and that's what makes the world go around. And that's what changed with a lot of people in the last couple of years, a failure to openly share a disagreement, discussion, to be curious, to admit, like a poker player that I am, that as conditions change, my ideas need to adapt. And I might be wrong. I've been wrong a lot in the past. I'm assuming I'll be wrong moving forward sometimes, not on AI. So if you're a family office and would like to be more familiar with our work, besides following me on social, go to angelorobles.com, simply my name, and learn more about membership and consulting around the world for family offices. I greatly appreciate all of you. Ram, you were incredible. I can't wait till you come back later in the year and comparing kind of what happened kind of as we expected. We'll see how it plays out with Trump, with Warsh, yen carry trade, AI. There's so many different things we discussed here that in October, November discussion 9 or so months down the road would be great to revisit. Again, I greatly appreciate you. Thank you all for the audience. Lumida, I highly encourage you to reach out. They have a wonderful team and incredible people, and I think they could provide value to you as an investor and a family office to at least follow and learn more. Ram, again, thank you so much.
Always a real pleasure. I love the critical debate and discussion. We need more critical thinking in the world. Thank you for your
Yes.
I know we're going to do more events together as well. I think in New York, we're planning some things together. So, yeah,
that reminds me to give thank you for bringing that up. So, for those of you that are in New York or would like to come to the New York area, I don't have my full calendar on the computer I use for this. I believe it's either March 24th, 25th, or 26th. Lumida is really anchoring, and I'm like the junior anchor of a program that is going to take place in the afternoon in New York City. If you're a Lumida client, a member of my organization, or selectively a qualifying family office, reach out to me or Ram and his team. We have room for a couple of more people. I will be there in person with Ram, and we'll do about a mini 45-minute version of what you're seeing here. So this is now over 2.5 hours. And trust me, 5 weeks out, a lot in the world is going to change. We'll pick new topics. It'll be fun. So if you want to come into New York, reach out to me, Angelo at AngeloRobles.com, or a DM, or Ram and his team. And we have some capacity for some people that would enjoy coming with us. And I do look forward to doing more with Ram that are in person, where we really go deep, but not as many broad subjects, but we cover 2 or 3 at a deeper level. And I think that's going to be a lot of fun. Thanks for reminding me about that, Ram.
You bet. Until next time, Angelo, always a pleasure. Be well.
Look forward to it. Thank you, everyone. Have a great day.
Cheers.
Cheers.